Hello, good morning, good afternoon, ladies and gentlemen. Welcome to our webinar. We are very sorry we are late because we suffered from some technical problems. We wanted to turn our cameras on, but unfortunately it's not possible. So you will just hear us, but you will see the presentation. Today, if you participated in our webinars in the past, and I can see we have lots of attendees that already participated in our previous webinars, plus we have also new attendees. So we hope you will also, those that are new with our webinar, this webinar will come back for next ones. We hope that you will also find it useful. Usually while we have webinars on economic subject, that's mostly myself that I'm speaking about this economic subject, but this time it's different. This time we have a special guest, my colleague Ruben Nizard from North America, who will show us developments of the US economy. Right now, I think it's quite crucial to follow that as not only from the point of view of the big stimulus of the US economy, but of course the US economy remains a large one, and it shapes not only the world trade but the global economy as well. So from me, just few housekeeping issues. The agenda of our meeting is the following. As I said, in a minute, Ruben will tell you more about the US. Then I will tell about Central and Eastern Europe. And as the final part of our meeting today, we are going to have the Q&A session. We hope you will have lots of questions to us. We will do our best to answer them. Actually, you can already start asking questions during the presentation. On the right-hand side of this webinar panel, you have the questions window. And if you have any questions, no matter during the presentation or after the presentation, during the Q&A session, please type your questions there. We will read them and we will do our best to answer them. This presentation today is recorded. You will be provided a link to the recording if you would like to come back to it or maybe share with your colleagues in your companies. More to that, if you would like to have the presentation that we are going to show you today, if you'd like to have it at your desks, it's possible. It's uploaded to the handout section. It's also on the right-hand side of this GoToWebinar tool. And this is the handouts section, and you have a file there with the presentation. Okay, so that's all from the housekeeping issues. Right now, I pass on to Ruben. Ruben, the floor is yours.
Well, thank you, Gregors, and I'm really happy to be with you today and to join you for this webinar. Thank you for inviting me to share Coface's view on the US economy and on the US recovery. Because more than a year after the onset of the pandemic, which triggered one of the deepest recessions in the post-World War II era, we are now in the recovery phase. You can see from Coface estimates and forecasts that after an estimated 3.6% contraction in global GDP last year, we expect a significant global recovery by 5.1%. But this 5.1% figure presented here is hiding a very uneven and unequal recovery from country to country and from sectors to sectors. One of the key difference in the growth momentum that the different countries will experience is obviously that the health situation, which is very different from one country to another, and the pace of the COVID-19 vaccine rollout is very different from one country to another. And a clear trend has appeared in the first half of the year so far is that on the one hand, high-income advanced economies have been able to secure supply and to start and successfully vaccinate. And you can see that most of the countries on the right-hand side chart that have a significant portion of their population vaccinated are high-income economies. They were able to vaccinate fast and have started to, in some instances, to ease restrictions that have been putting a lead on economic activity last year. You can also see that in contrast, many emerging markets are still struggling to secure this supply and will probably continue to struggle with the crisis and with waves of restrictions that will constrain economic activity. And that is very clear with recent examples from Brazil, from India, for instance, which are two key emerging markets. Turning to the US. The US was one of the first countries to approve vaccines and to roll out effectively, being one of the first countries to reach more than 50% of the population vaccinated as well. And it is helping because it has the US economy has been able to gradually reopen. And it is quite clear from the chart on the left-hand side that thanks to this reopening, the US is now leading the recovery among advanced economy and among G7 countries. You can see with the blue line on this left-hand side chart that the US economy level of activity is only 0.9% short of the level that it had prior to the recession, so in Q4 of 2019. In contrast, you can see that European countries, including Germany and France, are still about 5% below their respective late 2019 levels of activity, while for the UK, they're even further apart, close to 10% lower than the level that they had, the level of activity that they had prior to the COVID-19 pandemic and crisis. On the right-hand side chart, you can see the main contribution to this recovery. So the recession was triggered by a slump in consumption and investment, most notably. And you can see that thanks to very accommodative monetary policy, the investment component has recovered. More specifically, this very accommodative monetary policy has helped to lower mortgage rates, and it's supporting the residential investment. So, for instance, construction activity has benefited from this development and has been booming since the second half of 2020. But you can see that the main contributor to this recovery is actually the green bar, which represents private consumption. And this is, as Gregor mentioned in his introduction, thanks to massive support and more notably fiscal support. So the United States has committed a lot of resources to respond to the crisis. Congress has approved an estimated 27% of GDP of US GDP to respond to the COVID-19 pandemic and its economic impact. Among this response and in this response to the crisis, there are three main pieces of legislation that were approved, providing income support to households. The CARES Act in April of 2020, the Consolidated Appropriations Act in December of 2020, which was approved in December of 2020, and the American Rescue Plan, which was approved earlier this year in March of 2021 by the new Joe Biden administration. And these measures and these fiscal measures, they were mostly focused on income support. So it included, most notably, some stimulus checks that were sent directly to households to support consumption. From the left-hand side chart, you can see that it has been quite effective. With the gold bar, they represent when these stimulus payments were made. So in April of 2020, January of 2021, and in March of 2021. And you can see that in the three instances, it has supported a bump in consumption, and more specifically, a bump in consumption of goods, which has recovered quite significantly since the beginning of the crisis. After plummeting by by more than 12% in the early stage of the pandemic, the recovery has been strong and is now more than 15% above the level. Consumption is good, is more than 15% above the level of the consumption that of February 2020. The main issue is that services, you can see, are still lagging the recovery, and that's because obviously of these COVID-19 restrictions, which are only very gradually lifted. So this has constrained some growth, and that's but we expect it to recover going forward because there is a lot of pent-up demand for high contact services that many people were not able to consume during the crisis, and they will probably be a burst in spending on travel, restaurants, for instance, that will be very supportive of services sectors later in 2021 and in 2022. The pent-up demand will be able to be released thanks to the personal savings that has been accumulated, also thanks to the support, because not only did these payments and income support for household has helped to support consumption in the short term and consumption on goods, but it has also helped to build a cushion of savings. You can see that on the right-hand side chart. And you can see that since the beginning of the crisis, and it's a paradox to see that, the saving rates and the money that has been put into savings is higher than prior to the crisis. And in April of 2021, it's almost twice, the personal saving rates is almost twice as high as the 10-year average between 2010 and 2019. So it represents an amount in total of more than 1.6 trillion US dollars that American households will be able to spend in the coming months, and that are expected to support the recovery. But as I've mentioned, the recovery has already started, and consumption of goods has been very strong. Demand for goods, and especially durable goods, has been very strong, and it has supported good producing sectors, so more specifically the manufacturing industry. But in this first phase of the recovery, it has also created some headwinds on the supply side, because last year many industries were forced to reduce their capacity and their production capacity to respond to the crisis and to the health restrictions. And since then, they have seen a burst in demand that has been buoyed by this fiscal support. So it has created some strain on the supply chain and some supply chain bottlenecks. So focusing first on the chart on the right-hand side chart, you can see that the backlog of orders has been increasing gradually since the second half of 2020. So this indicates that demand has been very strong, but that manufacturers have been struggling to keep up with this demand. So the backlog of orders has been accumulating. At the same time, we're seeing that the level of inventories is declining and falling to low levels. It's because many companies had to draw down in their inventories to respond to the very high level of demand that the US economy is currently experiencing. So this is some short-term strain on the supply chain, but it bears a good news for future production, because with inventories being low, it means that going forward, demand from manufacturers will probably stay strong throughout 2021 and 2022, even if demand cools a little bit from on the consumer side, because the companies will need to replenish again their inventories later in 2021 and 2022. But right now it's posing some challenges in terms of and some issues in terms of the recovery. You can see that average lead time, so the time from order to delivery, is surging to new highs. And in May of 2021, it was estimated that the number of days that it takes from order to get the actual input, it took approximately 85 days. This is a record high according to this survey conducted by the Institute for Supply Management, and it is posing an issue not only because it's more difficult to source inputs, but also because it is putting upward pressure on prices of several commodities, and including in North America, we've seen energy commodities prices rise, we've seen steel prices rise, and lumber prices rise quite significantly since they plummeted last year. And this rise in input prices is being felt on headline inflation in the United States. In April of 2021, the consumer price index inflation rates reached 4.2%. This is the highest level since September of 2008, and it has raised some fears and some jitters on the market that it could be the beginning of an inflationary spiral, because we've seen commodity prices putting upward pressure on prices, and this very high level of inflation could be a source of concerns, not only because of higher prices, but also because it could prompt the Federal Reserve, so the American Central Bank, to remove extraordinary monetary policy support sooner than is currently expected by the market. You can see that this 4.2% inflation rate is far above the 2% inflation target of the Federal Reserve. But this 4.2% inflation rate should be also read with some caution. Yes, this is a very high in the short term, but it is important to remember that it follows a period of very low inflation. You can see from this left-hand side chart that inflation has quite significantly fell at the very early stages of the pandemic in April and May of 2020. It was close to zero, so there was almost no inflation, with some categories of expenditures experiencing some very notable price declines. This has especially been the case for mobility associated category of expenditures, and you can see that on the right hand side chart. You can see that, for instance, airline fares, lodging away from home, plummeted quite substantially in April last year, and many of the price increase that we've seen in April 21 and that are driving currently this peak in inflation are driven by these same categories, meaning that they are now catching up a little bit. So it's not quite unusual to see in this period where supply is adapting to the surge of demand, and when the economy is reopening, creating a surge in demand for things that many people did not spend on in the past 18 months, it's not surprising to see a surge in inflation. And also, it's important to note that this is not unusual to see in the recovery phase an increase in inflation. You can see, for instance, that in 2010 and 2011, after the great financial crisis, this headline CPI has averaged more than 3% for more than 10 consecutive months. So at this stage, even though there is an inflationary risk, we consider that this rise in inflation is probably temporary and will not trigger any action by the Federal Reserve in 2021. And that has been the key message from the Federal Reserve in the past months. And I think that looking at this right-hand side chart, it proves that many of these inflationary pressures are in the short term, but are likely to subside gradually throughout 2021 and 2022. Another reason why we believe that the Federal Reserve will continue to prove cautious on interest rate rise and on tightening its monetary policy is because there is still significant slack on the labor market. Because the Federal Reserve, in addition to its mandate to keep inflation stable and prices stable, is also targeting maximum sustainable employment. But you can see that we're very far from the levels of employment that the US had prior to the crisis. On the right-hand side chart, you can see that at the end of, in mid-May of 2021, the level of employment was still significantly below the level of employment that was experienced in February of 2020, 5%. It represents approximately 7.8 million jobs fewer than prior to the crisis. And you can see that it's already, we're actually after 15 months after the beginning of the crisis, we're actually at the same stage of the recovery than after the great financial crisis, even though the recovery has been faster in the initial stage of the recovery for the labor market. In addition to these people who have not returned to work and these 7.8 million that I've not mentioned, there is an additional 3.4 million people that have left the workforce and not returned yet. So in total, that's already close to 11 million jobs that have not yet returned to the labor force. And it signals that there's still significant slack in the US economy and that the recovery is not complete yet. But we are seeing in the short term some tensions on the labor market despite this slack. You can see from the left-hand side chart that the number of unemployed persons per job opening has declined quite fast since the recovery started in the second half of 2020, and is close to the level that were experienced prior to the pandemic. That's because the number of job openings has been increasing very fast, especially in the first 4 months of the year 2021, as the reopening has accelerated, and that's many employers are finding it hard to find workers. So there are workers that are looking for jobs. There are employers who are looking for employees, but in this initial phase of the recovery, you can see that they are struggling to find each other. So there's also a mismatch of supply and demand on the labor market, which is expected to be temporary again. And because of these signs that the labor market recovery is still in the way, that's also why we do not expect the Federal Reserve to tighten its monetary policy in the short term. To conclude, I would just like to say a word on business insolvencies in the United States, because they've behaved very unusually during this crisis, like in many other economies across the globe. You can see from the right-hand side chart that the number of bankruptcies filed in the United States in 2020 and 2021 has trended quite significantly lower than in previous years, despite the economy experiencing one of the worst recessions in its history. So that's quite a paradox that we've seen in many economies, and in the United States as well. This development can be associated with the extraordinary level of support that was provided to businesses, also to help them weather the crisis. And you can see that it has proved efficient when it comes to avoiding bankruptcy. But there are some details that are interesting there as well when you look at the numbers in details. If you look at the business bankruptcies by chapter, and if you look at in the 12 months ending March 2021, so most of the period that cover the COVID-19 pandemic, you can see that overall business bankruptcies have declined. But I think it's quite interesting to note as well that Chapter 11 bankruptcies have increased substantially and bulked this trend of lower bankruptcy. So what are Chapter 11 bankruptcies? That debt restructuring. So even though total number of liquidations has declined and has driven down the number of insolvencies in the US. We've seen a higher level of restructuring quite last year, and that's because mainly big corporations had to restructure their debt when confronted with this crisis. I think it's important when going forward because it suggests that part of the adjustment when it comes to insolvencies has already occurred, and that even though we expect business bankruptcy to pick up a little bit, we don't expect a wave since part of this adjustment has already happened. So this was it for me. Thank you for your attention. I think we will now turn to Europe and Central Europe for the economic outlook. Thank you again for your attention.
Thank you, Ruben. Thanks a lot for your very clear and comprehensive views. Well, I think my first impression is that although here we are in Europe, in Central and Eastern Europe, far away from the United States, but we have really many commons in terms of the economic situation. Just to mention a few of them: higher inflation, the situation on the labor market, where indeed this one also in the region is supported by various measures. Increased prices of commodities, or also a kind of paradox in terms of bankruptcies. So I think there are really lots of similarities. And well, right now let me go indeed to more details regarding our region, regarding Central and Eastern Europe. I will just share with you my part of presentation. I hope you can clearly see it. Okay, so let's go. Well, to have like transition to Central and Eastern Europe, I will somehow continue with subjects that Ruben already started. So with higher commodity prices. Here the picture you can see, let's say, it's a global one. But of course it applies to Central and Eastern Europe. As Ruben said, we have higher prices of commodities. Yeah, one of examples is Brent oil price, which, as you can see, especially compared to this first wave of the pandemic, those very low levels, we have a huge acceleration of Brent oil prices. Other commodities that are used by the manufacturing sectors, by various sectors, so lots of companies have to pay more for inputs to production. Also, we've seen already that, I think, when the pandemic started, the increase of food prices. Actually, the reasons, there was a number of reasons, not only due to panic buying resulting from the pandemic, from the initial stage of the pandemic, where people started to have a kind of stock buying, but also due to some weather phenomenon, like, for example, La Nina, also actions introduced by particular countries, just to mention Russia, which implemented an export quota, then export tax on grains, on food products. That all those issues resulted in the increase of food prices as well. But staying like more with commodities, we have here just 3 examples of that, how companies have to indeed how they have to pay more for inputs for the production. So indeed that means that they can sacrifice the margins, or they can just put those pressures higher on the inflation, so pass it on to final consumers. And here I would like to say it's not only in terms of commodities, in terms of those costs that companies have to pay. There are also higher costs of transports. On one hand, of course, those higher prices of oil, of crude oil, that impacts fuel, and that we've seen already in past months, increases of fuel prices. But looking overall at the transport sector, we have a huge increase also of the cost of the maritime transports. And here for us, from the perspective of Central and Eastern Europe, only few countries have access to the sea, but of course those costs apply also to us, because these really large transports of goods coming, for example, from China to Europe, from China to the US, that is all impacted by higher prices of costs, by the shortage of containers. Some time ago, we had also this issue with the Suez Canal, which moreover elevated the issue of this concern on transports. Of course, companies are trying to be the most flexible as they can here. They switch more like to the railway transport, also of course to air cargo transport, but even those latter two, of course, also prices and costs of those transports are higher than they were, for example, a year ago. So here with this picture, the US picture, the commodities picture, so let's say like a global picture of situation worldwide, let's take a look, let's take a closer look to Central and Eastern Europe. Ruben showed us the performance, the recovery process, or rather rebound process, because it's hard to say it about the full recovery. And I also wanted to show you the GDP level compared to the pre-crisis one. And the pre-crisis one, here I assume the last quarter of 2019. At that time, as you perfectly know, nobody thought that the pandemic will be worldwide, and to check if in our region, in Central and Eastern Europe, there are countries that are coming back to the same GDP level. And actually, there are some good information here, because we already have two countries that are back at the same nominal GDP level that it was in Q4 2019. As you can see on this chart, those are countries like Lithuania and Romania. Well, Lithuania recorded just I would say, mild recession of 0.8% last year. So it was also easier to progress, to have this recovery. But here we also have, after Q1 2021 data, we have also Romania back here, thanks to strong domestic consumption, household consumption, but also exports that helped to be back at those levels. In terms of other countries, the picture is quite mixed. We have countries like, for example, Czech Republic or Slovakia, which are very dependent on the performance of the German economy, on Western European economy, and also on the automotive sector, which, as you can see, according to latest data for the first quarter of 2021, and they somehow lost this momentum. And by the way, it's not only because of their exposition to export markets, but probably, as you know, in those countries we have quite strict lockdowns due to another wave of the pandemic that was introduced in Q1 2021, but not only in those two countries. I think at the beginning of the year, Central and Eastern Europe suffered much more from the pandemic that at the initial stage it did. I mean, here from the point of view of the health reasons, yes, we had at that time much more infections that at the first stage, at the first wave of pandemic, so in March, April, and May 2020. Looking at some more indicators in the region of Central and Eastern Europe, well, here I already said that we have some commons with the US, because indeed also here in the region, situation on the labor market, at least looking from the point of view of unemployment rates, it's not so bad. Here on the left-hand side, you have a chart with a few countries from Central and Eastern Europe. And as you can see, on one hand, indeed, unemployment rates increased, but not as much, not as strong as, for example, they were in 2013. 2013, we had quite difficult situation on the labor market here in the region. Also, we had at that time a double depreciation of the Eurozone, so the main trading destination, export destination of Central and Eastern European countries. So here, those stimulus measures that were introduced, those fiscal measures, they helped to reduce this impact on the labor market. However, if we take a look, for example, at the number of working hours, total working hours, we see that lots of countries, not only in Central and Eastern Europe, but also in Western Europe, they suffered, and this full rebound, full recovery of the labor market will take some time. And here, of course, a kind of uncertainty relates to that, what will be when those supportive fiscal measures will expire, will be phased out. Then we also could have some negative impact on the labor market. But just looking at household consumption, on the right-hand side, you have a chart with retail sales dynamics. And here, intentionally, I provided you with month-over-month changes, because it does not make sense, at least so far, to compare year-over-year changes that I usually show, because as you know, in March, April, we started to have lockdowns. We start to have this significant contraction of the economic activity. So those recent figures that have been released, for example, for April, or will be released also for May, they are skyrocketing, because they are compared to very low level of previous years, so-called statistical base effect. That's why I showed you here the month-over-month changes, but those ones are also impacted somehow by lockdowns, by some changes of consumer preferences and so on. But at least we can say that if we take a look at countries in Central and Eastern Europe, we do not have a, let's say, clear situation here, but we have a number of countries that in the last 1 or 2 months retail sales started to rebound, that the consumer confidence somehow started to improve, and I think it gives some path, some hope also for the stronger recovery in the second half of 2021, and hopefully also afterwards. So that's on the labor market side, on the consumer side. How does it look on the supply side, so like industrial production? Well, here, similar to global developments, the manufacturing sector leads the recovery in Central and Eastern Europe. On the left-hand side, you have industrial production, again, month-over-month changes, because similar to retail sales, right now it does not make sense to have many conclusions from year-over-year changes, because they are impacted strongly by the statistical base effect. To separate charts, the separated is Russia, because we have huge fluctuations in terms of Russian data in recent months. But here I would say that indeed data for the manufacturing sector, if we look at it from previous months, of course, we can see month-over-month improvement. Each month there's an improvement. There are some slight exceptions, like for example Romania, recently Russia, but when we conclude all of that, what happened starting, for example, this year, we can say that the manufacturing sector is the one that indeed leads the recovery, and also similar to the US, similar to the global activity, it's right now at much better shape than, for example, the services sector. And of course, the question is that what will be afterwards in next months. We expect that as the economic recovery should somehow speed up, that will also help Central and Eastern European economies, the manufacturing sector. The manufacturing sector is strongly dependent on exports, and that already and quite fast started to rebound already in 2020, actually roughly in the middle of 2020, when we had the first very important economy that started to recover, so China. And as lots of companies in Central and Eastern Europe are included in so-called global supply chains, they also are active exporters. That also helped the manufacturing sector, and this is also the contributor for the industrial production. And that's also the conclusion coming from PMI, so Purchasing Managers Index latest data. As you can see, for those countries that we have available data from Central and Eastern Europe, all of them are above 50 basis points line, and it is considered, if it is above 50, it is the recovery. In countries like Czech Republic or Poland, it's on all-time highs. So I think that on one hand, indeed, it confirms that new orders are increasing, that we have stronger output. But on the other hand, this is what Ruben said during the part talking about the US. Also here in our region, we have a huge supply constraints. So these higher prices of commodities, and also actually the shortage of commodities, I think maybe not a commodity, but the input used to production. That's a very good example of semiconductors that is used not only in the ICT sector, in the automotive sector as well, which is a very important part of the manufacturing sector in Central and Eastern Europe, that somehow stops this recovery that is driven by the manufacturing sector. And here, when we look at prices of inputs that companies have to tackle in Central and Eastern Europe, we have in recent months, a very strong increase of producer price index. And that's the chart on the left-hand side for those selected countries that you can see here. If we compare that to like years at the beginning of this decade, 2017, when we also had an increase of oil prices, the levels could be somehow comparable. However, right now we have a very steep curve. So the increase of these prices, producer prices, is very large, very steep, and it seems that on those elevated levels, it's going to stay with us. It already started to affect the consumer inflation, although in the past, as I said, there were prices of energy that impacted that, prices of fuels. Also in some countries, we have increases of particular taxes, like for example, the excise tax in Hungary. But nevertheless, this is the issue that should be monitored for next month. So how companies, not if, but I think how companies will transfer those higher prices of their inputs to final consumers, because it's not possible that companies would sacrifice all their margins just to take those costs on their own. It's likely to be seen also as a kind of upward pressure for inflation. And talking about inflation, as you can see, among those countries provided here on the chart on the right-hand side, we have Russia with the highest inflation in May, 6%. Actually increasing inflation, also the situation with on the exchange on the forex market made the Russian central bank already to increase interest rates twice this year, and moreover, it's quite likely that tomorrow, when there will be the next meeting of the Russian central bank, we will also see another hike of interest rate. In other countries in Central and Eastern Europe, well, I think that it's worth to mention that the Czech central bank is the one that is very sensitive to changes of the inflation rate. However, on the other hand, and I think it applies also to other central banks are right now quite afraid to dwarf the economic activity. They would like to wait more for the economic acceleration, and then if indeed inflation is like staying more with us, if this ongoing upward pressure for inflation, it's likely that we will see interest rate hikes. But I would say that not so far. Rather, we have to wait for such actions. And one as of final points from my side, in terms of investments, Ruben mentioned that investments helped also the US economy. And actually, when we take a look at latest data for Q1 2021 for Central and Eastern Europe, we also see that investments are going up. I think, well, at least for me, it's a kind of surprise, because I thought that companies will be more reluctant to invest, but likely with those challenges in terms of supply constraints, companies are right now more willing to invest, even if they are not so sure, not so certain if really the demand, the recovery of demand is sustainable. But as a first stage of higher investments, we have the capacity utilization that in Central and Eastern Europe are back or almost back at the pre-crisis levels. So the next step indeed is increasing investments. So as we also have this possibility of using the EU Next Generation Fund, so the EU Recovery Fund, which, as you perfectly know, EU funds are very important also for our region. That will also be a trigger for various investments, especially infrastructural investments. So in 2021, in the second half of 2021, I would expect investments coming back as a contributor of GDP growth. Regarding the vaccination data, the vaccination process, because that remains very important in the mix of economic outlook, the vaccination process became a very important part of this mix. Countries in Central Europe are going on; they are progressing with the vaccinations. If we would compare that to Western Europe, we are somewhere like in line. We are not lagging behind here, although we have some countries that are slower with that. So like Bulgaria, which especially at the first stage was slower, but then it tried to speed up, but it would be difficult to be right now at the same levels that other countries. Also Russia, despite having its own vaccine, as you can see, it's lower with the share of population of fully vaccinated share of population. On the other hand, we have Hungary, which uses not only those vaccines approved by the European Union, but also Chinese and Russian vaccines. So it was able also to be faster with the full vaccination. And as last point from my side, our recent update of country and sector risk assessments. Perhaps you are familiar with this tool that we publish on a regular basis each quarter. In terms of our country risk assessments, it's the tool that is somehow similar to ratings provided by rating agencies, but rating agencies focus on sovereign risk while we focus on the corporate risk. We of course take into consideration similar factors that rating agencies do, so like economic, political indicators, financial indicators of particular countries, but we add to that also our payment experiences and business climate assessment. During 2020, during the impact of the pandemic, we did lots of revisions, lots of downgrades of various countries, I would say a bulk of countries, due to the impact of the pandemic. Right now, as at the end of the first quarter of 2021, we started to do some upgrades. We upgraded countries like the United Kingdom, United Arab Emirates, Israel, Chile. So roughly those were countries which were and are faster with the vaccination process. That also started to positively impact the economic activity and also the business side. Right now we are in the process of the next revision of country risk assessment. So next month, early next month, we are going to publish the next barometer. So I encourage you to take a look at that. What will be the revisions, not only the country risk assessments, but we'll also publish our sector risk assessments. And here our latest revisions related to Central and Eastern Europe were regarding the textile and clothing sector, which was strongly impacted by the pandemic, also by the closure of stores in shopping malls, which are the very important part of the distribution part of the textile and clothing sector. So they suffered a lot from lockdowns. Well, in terms of other sectors, as you can see, pharmaceuticals remain at low risk. We have also transports at a very high risk. Other sectors are at high or medium risk. I will not go into further details. If you are more interested, please ask the question during the Q&A session or afterwards. You can of course also contact with us. And then finally we approach to the Q&A session. So as I mentioned before, on the right-hand side of this GoToWebinar tool, you have the questions window. Please type your question there. We will do our best to answer them. And just waiting for your questions, although I think there are already some questions. I just wanted to encourage you to follow our economic publications, because we issue lots of publications. A few weeks ago, Ruben issued a publication on the US economy. Recently, we also issued the China payment survey, also our views on the German insolvencies. As I said, each quarter we had the so-called barometer publication. Really lots of publications, which are a bulk of them is available for you for free just on our website. And I think the easiest way to be updated with our publications is that to follow our LinkedIn account. As we update that on a constant basis with the publications that we issue. Okay, so well, that's all, not from my side, but from the side of our presentations, from the side of slides. Right now, let's open the floor for questions. Let me take a look. If there are any questions. Yes, there's a first question. PPI measured by prices in local currencies or in US dollar? Well, those ones that I showed on the chart are year-over-year changes, and those were calculated from national currency. Yes, indeed. So well, I guess that your intention was that if it is impacted also by FX rates. So indeed, especially when because it's of course possible, at least Eurostat provides data on those parts inputs that are domestic and foreign ones. So if you would like to be more detailed here, indeed, we could have two separate charts on inputs on domestic side and on the foreign side. I didn't want to go too many details on that. Well, but as I said, this is PPI measured. It is PPI year-over-year changes calculated from the national currencies. Okay, so that's it. I encourage you to ask other questions to myself or to Ruben. Ruben stays with us, so I know he was very comprehensive and very clear with his views, but nevertheless, if you have any questions to him, please go ahead. Okay, we have another question. The lower rate of bankruptcy could be explained by the lower activity during the pandemic period, which would mean also lower number of startups. As I know, the startups have the most high number of bankruptcy. Yes, that's a very good comment, actually, because indeed startups, those companies are those ones that are unfortunately those that also we see in bankruptcy statistics. It's difficult to survive them. it's likely that during the pandemic we had a lower number of set up businesses. But here, looking overall at the situation with insolvencies, we see that those supportive measures were a significant contributor of that. We have not had a surge of insolvencies actually, and that it had not impacted so much companies already present in the business for many years. And we see it not only in case of insolvencies, but also in case of claims, in case of payment data. We issued a number of payment surveys, just to mention one from our region, from Central and Eastern Europe, and the Polish one we issued, well, we collected answers to that in November and December. And as a reminder, that was the time when Poland had the highest infections on COVID-19, when there are really concerns regarding the economic activity, regarding lockdowns. There were lockdowns implemented, and we had the improvement of the payment liquidity, so shortening payment delays. But we think that once those measures will phase out, that will result in higher insolvencies, probably not immediately. I would expect that insolvencies will start rising in the last quarter of this year. So when we compare 2020 with 2021, the numbers, the total numbers for entire years could be quite comparable. But then, since then, with a kind of delay, we will also have a share of some hidden insolvencies going out. Also, without these state support measures, unfortunately, not all businesses will be able to survive on the market. So we expect that we should be prepared to the higher number of insolvencies. Okay, let me take a look at other questions.
I can add a comment on the United States on the number of startups. Actually, in the United States, the number of startups have surged to new highs. So it might be surprising, but this is the case. We have only a few elements at this stage, but one of the key reasons why startups may have surged during the pandemic in the United States is that many people faced with unemployment try to start a new business to make some income. So that's part of the explanation. But it is also true that lower activity has impacted the rate of bankruptcy in the United States, since bankruptcy courts were closed for a couple of months. So of course it has played a role in a lower rate of bankruptcy in the United States.
Thank you, Ruben. Thank you. Very good comment. Okay, other questions. You mentioned that the current inflation rate in the US should, in theory, be temporary. What about inflation trends in CE? Well, so I would expect that inflation in Central Eastern Europe should stabilize. There are, at least from like the same like for the US, from the statistical base point of view, that there will be not a significant room for increases, already having inflation right now on elevated levels. Also, I would expect that like those components that were in the past, so for example, prices of fuels, they already started to stabilize. They will not contribute so much to increased inflation. But on the other hand, I think this impact of coming from increased producer prices index, so transferring higher cost of inputs to final consumers, it's not certain how companies will be willing. Of course, well, they could be willing to do that, but if they will be, let's say, brave enough to do it, because that could hurt also demand for their products. So I would expect that it will stabilize, but the upward pressure, it will stabilize in the second half of this year, but the upward pressure relates indeed to the impact of PPI and its transfer to CPI. Okay, next question. And what is expected growth of insolvencies at the end of 2021 and 2022 for CEE and the world? Any concrete estimates? Well, at this stage, it's very difficult to estimate insolvencies. Our models that used to work in the past, they do not work anymore because of those various measures implemented, because of the specificity of the current crisis and of these massive support measures that were introduced. So I wouldn't like to give here any precise figures, precise estimates, only that what I said in terms of expected timing of increases of insolvencies. Nevertheless, we did, our colleagues covering the biggest Eurozone economies did, they introduced a kind of new model on insolvencies. You can take a look at our publication on those countries and on the outcome of this model, and they estimated the share of hidden insolvencies, which, for example, is estimated in Germany or Italy to be around 30% of that what was already announced. And here, unfortunately, we do not have the same tools for Central and Eastern Europe, because we do not have such a data like for those big countries coming from financial indicators, which in terms of Western Europe are usually available from the stock exchanges. We have lots of companies in Central and Eastern Europe that, of course, are not going public, they are not listed on the stock exchange, and also the availability of those similar data is not so easy. So unfortunately, it's not, we are not able to do the same, implement the same model for CEE countries. Okay, let's take a look at other questions. In this critical situation, is an increase in currency depreciation expected compared to normal depreciation? Well, I think that here in terms of currencies, a lot right now could be attributed to the monetary policy. So not only the interest rate hikes like we have for example, we have had in Russia, also in possible just some changes of monetary policy, but also any kind of communication coming from central banks. So like forward-looking, I think that will have a significant impact for the currencies in the region. Plus, of course, that's what's happening here with the monetary policy, like in the US. Of course, our region, Central and Eastern Europe, maybe with the exception of Russia, is not very dependent on financing in US dollars. It's more correlated with the monetary policy by the European Central Bank. But nevertheless, this tapering by the US will have the impact, of course, on the emerging markets, like we've seen in 2013. Although I believe that not such a strong impact like it was in 2013. Right now, the situation is somehow different with all those issues that we have with commodities, supply constraints, other issues recovering from the pandemic. But nevertheless, looking just globally at emerging markets, it will remain a significant component of the view on currencies. Okay, I think I do not see any other questions. I hope I didn't miss any. Yes, I think I answered all of them. Well, we got another question to Ruben. We just got figures about inflation in the US. It jumps to 5%. What do you connect relatively high inflation with what would be the impact on the world economy from you?
Yeah.
From your point of view. Sorry, because it was cut from your point of view.
Yeah. So yeah, I haven't looked at the figures in details yet. They were just released half an hour ago. But I think that we'll probably see many of the same drivers of price increase that we've seen last month, meaning increased prices linked to increased mobility, higher prices of used cars, higher prices of airfares, because people are not traveling. So and prices are catching up now. So it doesn't change our view. We're expecting it to peak in May and to continue increasing in May. It will gradually and slowly decline in the coming months, in my opinion. Once we have these base effects, when this base effect wear off a little bit, we can expect that some demand will cool off a little bit once we've returned to the pre-COVID-19 norm. So that's still my core view, but I'd have to look at the numbers in more details to refine this answer. And on the second question, what would be the impact on world economy? Well, the US dollars and the US economy plays obviously a huge role in the global economy, and it could be a problem if inflation remains high for a long time, because it might prompt the Federal Reserve to increase its rates faster than expected, and it could trigger some capital outflows from emerging markets. So it could be very damaging, especially to emerging markets, if this inflation spike continues. But again, I think that there's a lot of noisy data currently, and that we will have to look into the details. And when you look at the details, there's no reason to panic about inflation. So we should remain cautious on that front.
Thank you, Ruben. Okay, and thank you to all of you that you attended our event today. We hope that you find it interesting, and we hope we will have you at our next webinars, not only on economic subjects, but also on other subjects. So far, thank you. Have a nice rest of the day, and of course, stay healthy. Thank you. Bye-bye.